Morning. Whenever I speak to people in the securitization market, they're often surprised about how relaxed we in the cover bond market are about commercial real estate, and in particular, how it doesn't attract the same kind of pricing differential to residential mortgages we see in their market. Strict eligibility rules, the dual recourse nature of cover bonds, have historically been a great explanation for our comfort with the asset class. But with everything that's been going on in the last 12 months, is this still the case? I think we all need to spend a bit more time understanding commercial real estate market and its response to the pandemic to be able to properly consider that question. So I'm particularly delighted to be able to introduce to you this morning Eri Mitsostergiou, Director of European Research at Savills. Eri provides research and advice on European property markets for Savills clients and has got over 20 years of experience in the European property markets, looking at how it responds to technology, to demographic change, to economic cycles, and I guess most recently to COVID. Thank you so much for joining me today, Eri. I know that you prepared a slide book, so can I ask you please to share with us your thoughts on the state and the outlook of the commercial real estate sector?
Good morning, Richard. Thank you for the invitation. Thank you for the introduction. I'm happy to be here with you, hopefully to help you understand the fundamentals of real estate today and our view on the future of the sector in the wake of the pandemic. I don't need to spend too much time, I suppose, on explaining how our lives have changed over the past 18 months. The way we work, shop, learn, socialize, and have fun have adapted to a new normal where well-being and health safety have become top priorities. These changes have had a direct impact on the way we use physical space. During lockdown, whole cities, offices, non-essential retail and leisure spaces were empty. Our home became our world. And that's where we work, that's where we spend time with our family, we enjoy our hobbies, we eat and sleep. On the other hand, some other asset types, other property types have had a different reaction to the pandemic. The acceleration of online shopping has fueled demand for logistics space across the globe, and supermarket chains have been expanding strongly. The pandemic also has raised the question, do we still need cities? The short answer is yes, we do. And there are a few reasons why. Cities are the most important locations for human interaction, and they will continue as centers of collaboration, innovation, and prosperity. Urban areas do produce more than 80% of global GDP, and by 2030, that share will rise to 90%. Of course, cities do need to evolve and in order to adapt to these new habits and priorities that we discussed earlier. So how has the pandemic affected the key real estate KPIs so far? Let's look into a few numbers to understand that. The disruption caused by the pandemic has affected occupier ability to pay their rents, obviously. Many buildings have been empty for a while with no users. Some specific data from the UK indicate that the shopping centers and leisure, as you would expect, had the lowest collection rates at 25% and 41% respectively. And these are these years' numbers. On the other hand, industrial units and offices led to a single occupier saw the highest rent collection rates at 84% and 80% respectively. Large occupiers chose to continue to pay their rents, despite the fact that employees work from home. The most resilient sector has been multifamily. Some data from the US indicate that rent collection rates were the highest and most stable in the multifamily sector. After all, housing is a necessity, and house rent is the last thing that people will stop paying during an economic crisis. Let's look into a residential sector into a bit more detail now. One of the arguments we've heard for the death of the city is that everyone wants to move and live in the countryside. And there has been indeed an increased interest in the countryside in some locations, especially in Europe and North America. but not everywhere, especially in Asia, this was not the case. In the meantime, residential price growth shows that demand is still strong, even for city properties. Of the 100 cities around the world where we track prices, only 16% of them saw values fall last year and 13% this year so far. House prices continue to rise, in particular in the most livable cities. As you see in this graph, like Auckland in New Zealand, some American cities that offer high quality of life, the Nordics in Europe. And we see some here, which these examples is that the ones that have shown strong and medium growth over the period of last year and this year. With regards to offices, which is one of the hottest topics in discussion these days in the real estate sector, is the biggest question is how is office occupier demand evolving, and are we going to go back in the office? It has been one of the big shifts. Hybrid working now it's more established, and there are questions how this will likely to look like in the longer term. Here we have picked up selected global office occupiers and put their intentions for future office working on a scale, from full-time working on the left to full hybrid working on the right-hand side. And there is a big range. And what's interesting is that tech companies, which you might have expected to be most open to a full-scale switch, still see the office as very much core to their future operations. I mean, they do postpone the return of the office based on the pandemic conditions, but their intention is to have people back in the office. And that should lead to a recovery of leasing activity. I mean, in the meantime, leasing activity obviously has dropped. And in this slide, you see that, take-up has dropped by 20–30% on average. But this slide shows the vacancy rates. It's a selection of European cities where you can observe that vacancy rates, although they have increased slightly, they do remain below 9% in most places. And 9% is this level that triggers rental falls historically. So in some cities, prime office rents have corrected indeed, like in Dublin and Spanish cities and Paris, but in others they still continue to grow. You would see even within the same country, in Germany, some cities rents are falling and some are increasing, and that's a matter of demand and supply as well. And these are cities that have quite tight supply conditions. A few words around the logistics and retail now, and another evolving two evolving segments. I mean, and as you see the retail suffering, on the other hand you see logistics really booming. Their fates are interlinked because the rising share of online retail sales is fueling demand for logistics warehouses across the globe. So the rise of online shopping is not a new trend, but it was heightened by the pandemic. E-commerce as a percentage of total global retail sales rose to 18% or more like in 2020. And that compares to 13.6% in 2019. The projections show that this share is expected to continue to rise, and e-commerce to capture at least 1/5 or slightly more of all retail sales in a few years. That means that logistics take-up is also rising. Again, that's an aggregate of a number of European markets, which show that the logistics take-up was, in the first half of the year, was 60% above the half-year average of the previous decade almost. Retailers with strong online presence and e-commerce operators are the ones who drive demand for space in this market segment. In the next slide, we see that in Asia, things can be a little bit different. The impact of rising e-commerce has been obviously negative for physical retail across the globe. But in China, where after the kind of the lockdown measures have loosened a little bit, the country has seen crowds heading back to the shopping centers. And this is in spite of the fact that the country has one of the highest e-commerce penetration rates in the world. Almost a third of all Chinese retail happens online. So how is the current state of investor demand for real estate? A few comments around the capital market trends with regards to real estate. If we observe the direction of yield trends and the level of yield trends, these show that prime yields across sectors, except for retail, are at historic low levels everywhere. And that reflects the confidence, investor confidence in real estate. The next slide shows a bit like the liquidity situation in the market. And according to RCA, the market liquidity bounced back in the second quarter in 2021 globally. This reflects a greater amount of diversity of capital targeting the global real estate markets. And that also implies that until the end of the year, we should see investment volumes to recover further. However, this obviously is dependent on the Delta variant and all the limitations in travel that we may see, because limitations of travel have been the key reason why real estate transaction activity has slowed down. There is so much cross-border investment activity, so much cross-border capital from different geographies that accounts for a big part of activity, and that has stopped obviously with travel restrictions. I would like to talk now about sectors, because that's an interesting trend. That there are some interesting trends that we see which differentiate this cycle from the previous ones. So looking at the previous cycles, when we have a circumstances of a downturn, what happens is that investors shift to core. There is a sharp rise of global investment in core assets, which are preferred as safer. And that trend is playing out again this time in this cycle. Already this year, core investment has accounted for 71% of deals globally. And that shift to core historically meant investment into income-producing CBD offices. These assets were seen as the most stable, safe, secure ones. And while they remain the largest and most liquid part of the market globally, although with a lower share these days, there are some questions around their future and about, there are some questions if they are as core as they once were, really. And I think the answer to this will come when we know what our future working patterns will be, and when this pandemic, if it's not over, at least like it doesn't affect our lives as heavily as it does now. So past cycles do give us some clues, but this is not a normal downturn. Will things be different this time? The government response to the pandemic has been unprecedented in terms of fiscal and monetary support, and that has served to make real estate actually look good value compared to other asset classes. The other thing that is different is that some sectors in particular are emerging stronger from the crisis. And this is more because of structural reasons, like technology, social change, demographic, etc. This means looking to the sectors of the future, that science and research-focused properties will become more in demand. Data centers, ESG compliant assets of all types, all these will become and have become assets that investors are chasing and are trying to find opportunities to invest in. So We surveyed our global research network. In the next slide, you will see a map which shows the intention of the kind of the investor intentions for investing, where to invest next year, and which sectors are they expected to invest next year. And you can see in this map that in more than half of the cities surveyed, office is still expected to be a dominant asset class for investment the next year, particularly and mostly in Asia and core European markets. While on the other hand, you see a lot of intention to invest in residential in the US, and you see the emergence of the sector in Europe as well, with the yellow pin. Whilst the red pin represents logistics, and it's another top pick for this year, next year for investors. These investment trends will also shape the outlook for yields. And in this chart, we see the expected direction of yields over the next 12 months. Offices show remarkable resilience from an investor perspective. Our researchers, because this is a result of a survey of our analysts across the world, they anticipate yields to remain either static or fall in offices. And this shows how important the office remains as a place to foster collaboration and company culture. Now, for industrial and residential, a majority of our analysts also expect yields to move in, which reflects basically investor interest in beds and sheds, as we say in the real estate industry these days. And it's a trend that we see already, you know, like the share of these two sectors, beds and sheds, all the living sectors and all the warehouses, is rising fast. Another point to pay attention to with regards to the results of this survey of our analysts globally is that 75% of Savills research heads indicate that sustainability is an important consideration for investors. And looking ahead, buildings that do not meet desired criteria or government regulations risk becoming stranded assets. Many investors are getting ahead now to future-proof their assets by upgrading them, changing their use, or selling them. And the pace of change means that investors are hedging against a brown discount rather necessarily pursuing green premiums. Which are the rising sectors? It's not even just beds and sheds anymore. There is another one now, sector that it's growing in importance. It's a medical sector. So it's meds, beds and sheds, if you like. And the innovation in healthcare, coupled with an increasing focus on well-being following the COVID-19, has brought life sciences to the forefront of people's lives. And this has heightened the investment appeal of major life sciences centers. So meds extends to healthcare in general, a sector which is very much in the spotlight after the last 18 months, and one where technology is revolutionizing its delivery and real estate needed. I will leave you with a few final thoughts and conclusions. Emerging from this recession, real estate demand is bouncing back fast, but there is a lot of money chasing the same things in the capital markets. I bring it back to those fast-growing sectors and niches, particularly those driven by knowledge industries such as life sciences. Although those specialist sectors also require certain expertise, and also their size and liquidity is still limited. Finally, the ESG agenda means that there is a general flight to best in class across all sectors, and that's driven as much by occupier demands as well as investor ones. ESG compliant buildings are now truly essential rather than a nice to have. Thank you very much for your attention.
Thank you, Eri. I take away from that a lot of really relevant things. I take away a little bit of reassurance that real estate continues to be an attractive proposition, but that it's a much more nuanced picture than perhaps it was before. I think that for covered bond investors, the disclosure within cover pools, sectoral and geographical exposures is increasingly useful. But if I can, Eri, can I just pick up on your point about environmental and social factors? Because that is something that we're covering at a lot of panels at this conference. We talk about a huge amount in the covered bond market, and particularly the upgrades, the energy efficiency upgrades of inefficient old buildings. Banks are very keen to fund this. It's something that we all want to do. We want to be seen to be lending money to allow it. But ultimately, who pays for it? And in particular, how easy is it to pass on the costs associated with energy efficiency onto the final tenants?
Well, it is a hot discussion in the real estate industry, as you understand, because obviously investors are also keen, real estate investors are also keen to either upgrade existing buildings or invest in value add opportunities where they can, they can improve the green credentials of buildings, etc. And the calculations are tough because there are costs obviously involved. The question is, can they be passed on to the tenant? I mean, our view is that the best buildings, the best in class, they will probably become more expensive. And that will be a combination of how, the fact that they will be more costly to deliver, but also because there is going to be still a lot of demand from occupiers as well. And I believe that the solution to this equation should and will also come from the public sector. There are incentives required to accelerate, the upgrade of the building stock to the right standard, and there is an urgency to do that. So governments, I think, will offer, and they're already offering certain incentives, tax breaks, low, attractive, borrowing, and that happens particularly in the residential sector, where ownership obviously is more fragmented, and this process might have to happen by the owner occupiers themselves. So I believe in the end there will be found a formula where there will be more public and private collaboration on this matter.
Thank you. Another area that we don't have a huge amount of time left, but it's something I really do want to ask, because so many investors now are talking about perceptions of inflation risk. And historically, commercial real estate is one of the great hedges for commercial real estate. And everything that's going on that you described in your presentation, is real estate still able to be an inflation hedge?
Yes, I mean, another discussion we have these recently in our calls, and when we all meet and we try to form our views and outlook for the sector, and it is a risk that we see currently, and we get the advice of our economists as well on that one. And I mean, again, there is, the economists are quite reassuring that this is a short-term kind of reaction to the tight supply that we experience globally, and that is not going to, to worsen in the mid to long term. Nevertheless, and no matter what, real estate remains a hedge against inflation, I believe, because of its very nature of lease terms that you see in most sectors, in most countries, where rents are index linked in most cases. So the real value of your income stream is protected.
Thank you. And in general, thank you so much today for your presentation and for joining us. I think this is a topic we're going to need to keep on top of at future conferences as the sector develops. So it's been really helpful speaking to you today. Please stay tuned. We're now going to be looking at, we've got a panel that's going to be looking at the role of covered bonds in developing economies and how it contributes to social development goals. Until then, thank you for listening, and thank you once again, Eri.
Thank you, Richard. Pleasure.